Costa, the founder and CEO of Azuria Capital, is joining us now to talk copper, gold and treasuries. Well, Tavi, it's good to be speaking to you again. As always, how are things? How have you been?
I'm good. How are you?
Yes, very good. Thank you. Very good. I'm very pleased to be catching up again. I like to talk over some of your LinkedIn posts that you put up. On this first one here, this chart you did the other day, copper versus gold. You say copper has been telling us all along that gold has some catching up to do. The lag is your friend. So just talk us through that. Why is copper telling us that gold has some catching up to do? What's the correlation here and why is it so important?
Well, usually when you look across the metals, what you tend to see is that copper tends to be the most volatile one, or the one that tends to really be damaged by the volatility on the downside in particular. And when we're seeing this correction in the gold prices over the last few months, it is remarkable to see how much copper has been so resilient and continuing to make new highs over the last few weeks. And despite this disconnect with gold prices, to me, it's a bigger tell that gold prices have a major catch up to do than copper having to fall much further, which a lot of people thought that was the case. The other interpretation of this chart that I thought was interesting, which was a narrative, and a classic example of not believing in narratives that are not necessarily true. And people tend to extrapolate these things as if it's the main reason for it. But a lot of people said that it's because of the sulfur supply constraints due to the war in Iran and so forth, and the Strait of Hormuz, and the availability of sulfur, especially for copper mining companies, of which were having issues with production, and therefore copper prices were staying much higher because of those reasons. While I believe that is the case and that is a possibility, obviously, that's not the main factor driving this divergence. And so you got to pay attention to, if you zoom out a chart of the copper and gold price all the way back to the 90s, you will see these two things, they follow each other very closely. And so the bigger question is, if the supply and demand constraints are really causing the copper price to continue to move higher, one would only think that gold prices would actually do exactly the same. And so that's the conclusion of the chart, if you will.
Okay, so really what you're saying is gold has some catching up to do on copper here to match historical norms effectively. Maybe the Iran war there is just causing a little sort of breakaway temporarily, but ultimately you see that catching up in due course.
I do, and that doesn't mean I also think that copper is expensive or anything along those lines. I just think that copper is an important signal for gold. They're both in very different situations today. Copper, in my view, if you look at copper relative to gold prices, so take the copper to gold ratio, you will see copper is at one of the cheapest levels in history. And so copper is still an incredibly undervalued asset to own, in my opinion. The only thing I would mention there is that gold is in a different scenario. Gold is not too long ago, extremely oversold, and it's just kind of rebounding after reaching those levels. And so, I suspect we're probably going to be, marching towards new highs here in the next, for the next 1 to 2 years. I think that we're going to continue to get into that upward trend that we've been, because it's, in my view, we're in a secular bull market here.
Absolutely. Well, I want to talk about gold in a moment here, but just let me pick up on the fact you talk about copper being relatively cheap at the moment. And of course, you put this chart out as well very recently, just about a week ago here. And it's a technical chart looking at copper miners. So I know you're very good on the technical analysis. Could you perhaps just explain some of the levels that we're seeing here and why you think that the copper miners are on the brink, as you say, of a significant breakout?
Yeah, and that breakout ended up already happening here because that chart is a 1 week or two old, but it's still very relevant because if you'll notice the breakout that we saw back in 2024, 2025, that kind of led to a major move in copper miners. Now, we can't just consider that's likely to be that will play out as exactly the same way, but certainly this is a roadmap. Usually when you have these types of sort of energy that tends to be established right below a major resistance. And this is not a major resistance, but it's quite significant because, as you know, you pointed out in the prior chart, copper prices are already making new highs here. So copper prices are also leading copper miners as well. And so in my view, one of the main things that we haven't seen yet in the copper space relative to the gold space is that with the change in gold prices that we've seen over the last 2 years or so, which has been very different than the copper price, and you can see that the margins of majority of the companies in the gold space have really never been anywhere close to what they are currently. And so I suspect that the copper space is going to be the same way. And as soon as people realize that with the move in copper prices continuing to accelerate to the upside as we enter a phase of new discoveries in terms of price wise in terms of the metal, I believe that copper miners are also going to see a tremendous change, a very substantial change when it comes to their margins. And so I think stock prices will lead that shift in fundamentals. And so what we're seeing today is just the beginning, in my view, of an acceleration to the upside in the copper mining space. That is, to me, one of the most compelling ideas in the mining industry.
Good. That's very good to hear. Excellent. Could we just finish off talking about gold then? And of course, it has started a move this week. And Bitcoin as well, for that matter, is doing quite well. This is probably, I would suspect, in response to the Treasury announcing the buybacks of the old dated bonds. And I believe that's to encourage liquidity in the younger bonds there. And this is going on through September to November here to the tune of about $4 billion US. So would you agree? Is that a bit of a catalyst that's causing perhaps a bit of fear, maybe, that's causing the gold price to rise? What do you think how is that relevant to what we're seeing at the moment with gold moving up?
Well, the situation with the gold price, given what's happening with the Treasury market, is absolutely critical. What we're seeing with the Treasury market is basically the Federal Reserve and the Treasury market basically, showing their cards. They've been bluffing this whole time by thinking that yields can rise and basically playing a big card of rate hikes and other things that are just not sustainable, and the economy cannot tolerate given the amount of debt that we have. At the end of the day, when you reach these levels of interest payments to GDP, you have to direct your policies, fiscal and monetary, towards lowering that debt service ratio at all costs, basically. And the cost is the currency, and the cost is also manipulating rates has also an impact on inflation. And so I don't want to be betting against those trends. I think that the dollar here, while a lot of people have been focused on the Treasury market, notice what's been happening with the US dollar, which has been devaluing and depreciating versus other fiat currencies. And that is by design, because what they're trying to accomplish is making US exports more attractive. And by doing that is reducing the burden that we're seeing on the trade balance problem as well. And so the only way to accomplish that is in the short term is by devaluing the dollar. So notice that that's also taking place. But that's all plays a major factor into gold, which is obviously acting extremely well here. Gold probably broke out yesterday, is following up here on a similar move today. Not as strong, but silver is now breaking out in quite significantly, which is a huge move. And you can also look at platinum also breaking out. I think it started yesterday, and now today is firming up above important levels. And Bitcoin, by the way, I actually bought Bitcoin. I haven't bought Bitcoin in ages. I bought it a few days ago. Luckily, before this move. I'm not that lucky usually, okay? So that's why I have a smile on my face. But I didn't buy enough. Otherwise, I would have a much bigger smile. But I did buy some. I just thought that Bitcoin was just in the toilet when it comes to sentiment and all sorts of things. I'm not here to become a full crypto bro, but I'm still a mining investor for most of my time. And so. But it's it's fascinating that what we're seeing is hard assets are improving, are big beneficiaries of this environment, and it will likely to continue to be that way, in my opinion.
Good. And just finally, Tavi, if I can here, I do. It does seem clear, and I've seen quotes around on the internet at various times, that the US is effectively led by the bond market. So when the bonds start to move, they blink effectively. But I want to get a bit of an understanding from your point of view about the macro of where the US finds themselves in a situation, because of course they have the big debt, so they can't have too much rise in the interest rate, because then they can't service the debt. And they also want inflation, I believe, because then that helps to inflate away the debt. So is there like a balancing act going on here? Because I see articles around which talk about the era of cheap money is over, talk of mortgage rates sort of at 7% here, but at the same time the Fed want the lower yields. So how do those two things sort of fit into each other, do you think?
Well, it is true that I think the era of cheap debt is over, and what we're seeing is the repricing of that in the cost of capital, of course. That remarkably, companies are still borrowing money at very low rates relative to even the Treasury market, and even when you look at dividend yields and all sorts of things relative to what Treasury markets are offering in terms of yield as well, or returns, are much lower than what's supposed to be risk-free by the Treasury market. And so it is interesting how that's playing out. But I would say that even more maybe relevant to all this is the inflation aspect, is this idea. So first of all, we need to pay attention to particularly what's happening in the policy side of things. I mean, we've seen now a push towards taking the Fed out of control in terms of monetary policy and leaving this to the market. But then, rather than letting the market, solve that, we're now having the Treasury Department take control over this whole thing, and so it all sounds great if we all we're doing is stepping back and saying, well, we don't need a central bank. All we need is Treasury yields to tell us what to do. Oh, but wait a second. But we also need the Scott Basson buyback program to lower yield so we can, and so it's just fascinating how this is happening. I just think the U.S. is looking more and more like an emerging market, and we as investors need to be aware of that. And we're no longer in a place where U.S.-based assets, in terms of valuation, deserve the premium that they have. And be careful out there. Like I'm been most of my capital is invested outside of the U.S. Today, and I do think that's a disciplined approach towards the situation here.
Okay. Thank you very much for your time. I'll just finish with one of your quotes you often do put on your tweets and your LinkedIn there. None of us have enough hard assets for now. Thank you, Tavi, for your time.
Thank you, Mark. Take care.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at StockBoxMedia.com. Thank you for watching.